Hedge funds have a reputation for making ridiculous amounts of money, but are also known for misleading clients, creating massive trust issues. That includes incidents like Bernie Madoff, who ran a decades-long Ponzi scheme under the name of a hedge fund. If you are someone who is doing well for yourself, you will probably, at some point, be approached by someone to invest in something. Maybe a business, maybe a project, maybe a hedge fund. They'll make it sound great, and they'll probably include plenty of details that go right over your head. That's on purpose. I'm Grady Cool, CEO of Cool Wealth Management. I'm going to tell you everything you need to know about hedge funds so you don't get screwed if you're given an enticing opportunity. I think a little bit of context can go a long way. So let's take a step back. Hedge funds have been around for more than 50 years. The first officially recorded hedge fund was back in 1949 when Alfred Winslow Jones started a partnership that used a combination of a strategy of long stock, which means just buying the stock, short stock, meaning taking a bet that the company will go down in value, and leverage, meaning cheap debt, in order to amplify returns. This strategy was slow to take off. There were small exceptions throughout the 1980s, such as Tiger Management, but it wasn't really until the 1990s that hedge funds started to take off. One of the easiest to identify points for why this happened was when George Soros, quote-unquote, broke the Bank of England by betting against the pound, making over $1 billion in a single trade. That's insane. It attracted a lot of attention and a lot of investing dollars. Whenever that much money starts getting moving, there are going to be miscreants. Tech stocks blow up, creating the dot-com bubble, which is then later followed by the housing market crash in 2008. Both situations were riddled with misinformation and amplified by hedge funds trading billions of dollars in the marketplace. To go through each and every hedge fund and each and every incident misses the point. Every significant economic downturn from the 1990s up through about 2010 involved hedge funds either acting in a legal gray zone, some hedge fund manager being in way over their head, losing tons of investors' money, or doing things that were just straight up illegal. This created a nasty reputation. People love the idea of making billions of dollars. They really do. But it is hard to shake a reputation like that. I was one of those people that got caught up in the glim and glamour of making billions of dollars. Back when I worked at Morgan Stanley, I considered a career in hedge funds. If any of you know anything about that world, you'll know that it is very hard to get a job at a hedge fund without knowing somebody. So I did a lot of research. Because hedge funds are so secretive about their investing methods, there's not a lot of detailed information out there. But there is some. In my research, I learned that hedge funds boil down to two main categories. There's the first group that does what a hedge fund was actually originally designed to do. They were originally intended to be an uncorrelated return for your portfolio. Most growth in an investment portfolio typically comes from stocks. Investment managers are constantly looking for things to invest in besides stocks that have a good risk-to-reward ratio so that they can add diversification to their portfolio. Their hope is that if stocks are doing poorly, then one of these other assets will make it so that they don't do as poorly during that time period, basically offsetting each other a little bit. There are plenty of hedge funds that do an honest job of this. They average around a 4% return whether the market is up or down. We'll get into whether that's a good thing or not later in the video. This is where more shenanigans tend to happen. Most modern hedge funds employ a team of PhDs from the top universities like MIT, Harvard, Princeton, etc., so that they can build algorithms and AI that are able to find patterns that humans just aren't able to find anymore. This is supported by supercomputers that are located right next to the stock exchange, so they can make a trade as quickly as possible as soon as the computer gives the green light to go. There is an entire book called Flash Boys about how hedge funds were fighting to get just a little bit closer to that stock exchange. The speed and the constantly updating algorithms are what allow these hedge funds to stay ahead of the curve. The problem is that basically almost none of them have been able to keep this going for more than 10 years or so, There are exceptions, I will give you that. But do you really want to bet your life savings on those odds? Again, we'll get to that later in the video. The other half of these balls to the wall, highest possible return hedge funds play in a legal gray zone. What I mean by that is that, well, some of the information might not be quite illegal because they have friends on the board of directors that give them some information that isn't quite public yet, or whether it is just quite insider trading. There are bad actors. One of the biggest issues is that sometimes these two types of high return funds get mixed together, creating more trust issues. We need to talk about what hedge funds aren't and are good for so you don't end up losing money for trusting the wrong people. If you're looking for some investment that will beat the stock market without having to take on a lot of additional risk, you are in the wrong place. There are means to beat the stock market. Don't get me wrong. There's saving on taxes, there's leverage, there's other options. But if you're looking for something that has no additional risk and doesn't require additional work that beats the stock market, that just isn't really a thing. You might say, well, what if I'm okay with additional risk? That's fine, but there's still the lack of information you need to consider. As we talked about earlier, hedge funds don't like to give away information about their investing methods because then other people would just copy them, thus defeating the purpose of the fund in the first place. If you're going to take on additional risk, you want it to be calculated risk, not just something that sounds cool. Now, what are hedge funds good for?
Finally, getting to the point!
Hedge funds can work well for what they were actually originally designed for, an uncorrelated return to the stock market that can be used for diversification. I would say that they perfectly fit the description of an alternative investment. If you're looking for an alternative option to the standard, typical stocks and bonds, then hedge funds might actually be a viable option. They're usually a little more risky than bonds, and they tend to be less risky than stocks. So, if you have personal preferences, let's say you don't like bonds, then maybe you could use a hedge fund. If you don't like stocks, then maybe with a little bit of leverage, you could use a hedge fund. Do you really need a hedge fund though? Personally, I don't think so. I appreciate that there are alternative options like this that exist, but they're just not my personal preference. Let me explain why. If you invest in stocks, bonds, or cash equivalents, then you can use an ETF, and there will be an expense ratio of around 0.05%, and you know very well what it is that you are investing into. If you invest into commodities like gold or silver, then again, you can use an ETF and pay an expense ratio of about 0.5%. Even with a REIT, which is basically an ETF for real estate, you'll be paying around 0.5%. With hedge funds, you're going to be paying closer to 1 to 2% per year. The percentage difference makes a huge difference when you're paying it year after year after year. That type of fee structure makes a lot more sense if you were going to be paying for the super high balls to the wall return. But again, as we went over, that's not a very good idea. The other big thing is that if you don't understand 100% what it is they are investing into and why they're investing into it, then it's easier to make mistakes. And in a situation like that, it's easier for the fund manager to make mistakes, which they do all the time. I prefer a consistent option that I know will do well. Now, there are no guarantees in finance. That is basically illegal. But I do appreciate 100 plus years of history behind what I'm investing in. Hedge funds can be a viable alternative, and it's important to understand what you're putting your money into. Who you trust with your money and what it's doing are absolutely essential to getting a consistently good portfolio. Now, what they're good for? Diversification. What they're not good for? Blockbuster returns. Hope you learned something, and I will see you in the next one. Bye.